Right now we're in the midst of one of the most rapid periods of change in the UK debt markets for the last 10 years. In 2005, banks dominated the lending landscape. Today we're transitioning rapidly to a US model where the range of financing options available to mid-market companies has expanded dramatically, now encompassing asset-based lending, private bonds and institutional debt alongside traditional bank finance. With continued low interest rates and quantitative easing, 2015 has seen an explosion of pension and direct lending funds targeting the mid-market. Most pension funds target real returns of circa 8% per annum, and if you'd invested in corporate bonds from 1981 through to 2015, your average return would have been around this level. Today, corporate bonds are yielding 4%, and 5-year treasuries are yielding 1.5%. So, as a result, a wide range of pension funds and investors are setting up direct lending strategies, targeting the high yields available in the mid-market. This is good news for mid-cap borrowers. We estimate that there's now in excess of £35 billion of direct lending funds dry powder looking to be deployed in Europe in 2016. These new lenders have made new products and new structures available to the mid-market private companies. In 2015, we've seen more companies using so-called unitranche facilities with no amortization. Additionally, funds can underwrite large amounts, up to £150 million, and they're able to move quickly. For many companies, this is a really compelling cocktail. But in 2016, we see the market continuing to evolve, with more deals being structured with a combination of cheaper first lien super senior bank loans and second lien finance provided by specialist funds, combining the flexibility of bank finance with fund-based structures. We also see more deals in 2016 being structured as cov-lite, with limited financial covenants as borrowers exploit the excess liquidity in the market to secure greater flexibility. In 2015, we've seen about 3 times as many deals being structured cov-lite with just incurrence-only tests as in 2013. With regard to banks, some commentators predicted the withdrawal of bank capital this year. That really hasn't happened despite the fundamental drivers of tighter regulation and greater capital adequacy regimes. Partly off the back of continued quantitative easing and a lack of big-ticket M&A, we've seen plentiful bank capital in 2015. Also, banks have responded to competition from funds by providing greater flexibility around structures, and a higher number of companies are now securing 5-year funding, and loan pricing has come off by circa 20%. In 2016, we see more banks teaming up with funds on a combined basis. We think these favourable conditions will continue in the first half of 2016, but the elephant in the room is what happens when interest rates rise. And in our view, undoubtedly banks will move quickly to pass on higher borrowing costs to both corporate and retail borrowers. Cheap and plentiful finance and a range of financing options has pushed up valuations for businesses being sold. Average EV to EBITDA multiples are at a record high in the US, above 16 times and above 9 times in Europe. It's a good time to be a seller, but for buyers there remain concerns around issues including the strength of sterling, European GDP growth, the pace of China's economic growth and the Brexit debate. In summary, the broader backdrop is that it feels very much as though we head into 2016. There'll be a market readjustment at some point. If you're a corporate looking to refinance over the next 12 months, the arguments in favour of moving your transaction forward sooner rather than later are compelling.